I knew I had to choose one vehicle, and that was multifamily for me at the time. I understood the principles of single family and the scalability of commercial real estate, and I felt that multifamily was a good avenue. So
Love that.
right after that first unit, I had a 12 unit under contract while I still own that first unit. It was a lot more fun to talk to investors than it is property managers. And they said, like, I'm finding out of problems on a property, way after the fact. So,
It's hell. I'll tell
yeah.
you that it is hell when you have those calls with the property managers and they want to bring something up and then you say, well, how long you known about? Oh, a couple months ago. Why wasn't I aware? I had a girlfriend and this is Uptown Charlotte. We call it Uptown. I would stay at her place when I didn't have my son, and so I'd stay at her place and they had an indoor hot tub. That thing was broken
Yeah.
90% of the time, and I was just thinking as an apartment owner because we own assets. I'm like, wow, this must be a big line item. Not only that, elevators. Elevators are very expensive. People don't realize what you have to budget just for maintenance and requirements by the state for elevators. Those are expensive. Elevator goes down. That could be $1 million, depending how tall your building is. Welcome to the Chris Salerno Show, your go-to for real estate, business, health, and family insight. I'm Chris Salerno, CEO of QC Capital. Each episode, we explore the latest trends and expert advice from industry leaders. Whether you're an investor, entrepreneur, or seeking balance, this show provides an inspiration you need. Join us and elevate your game on the Chris Salerno Show. Welcome to the Chris Salerno Show. I'm your host, Chris Salerno. Excited to have Brian Wagers on here. He's going to give us a big wealth of knowledge when it comes to the multifamily space coming from the sales background. Brian, I've known you for how long?
A couple of years now.
Yeah, it's been a couple of years.
We know a lot of the same people, go to a couple of same events. So here we are at another one.
I know. Excited to have you down and have everyone listen to your background and where you came from. And before we dive into your sales, before we dive into, what you're doing in the multifamily space right now, let's bring it all the way back to maybe high school, college days. Let's talk about what were you doing back in the day?
Yeah, high school, it was just me and my mom growing up. Dad was military, traveling around country. My mom was a small-time entrepreneur, and she worked her butt off to provide for me and played sports all throughout high school, football, focused on that in high school. Wrestled a little bit as well, and then went off to college, went for a finance degree, got to upper level accounting classes, did fine on lower level accounting, upper level accounting, couldn't even stay awake. So switched it to economics, wanted to go out of school with personal finance. No one would hire me. It's too young. They wanted me to have a Rolodex of people to call on, and said, all my friends are doing their fifth lap in college, but I'll call anyone you want me to, but no one would hire me. So I had a buddy, fraternity brother at Morgan Stanley, said, hey, there's a sales commission job. You should go check it out. I know a couple of guys over there that are killing it. So went over there. The base was $35,000 a year, but it was uncapped commission, and put my nose down and, became successful in sales right after college.
Love that. And is that the phones? On the phone?
Cold calls. Yeah, it was 100 cold calls a day.
Ooh, when I was a residential broker, I started out door knocking, and then I realized that it's not worth my time because I'm driving the whole day just to see a couple houses, essentially all the expireds and withdrawals. So then I said, I need to master the phone. I need to master that phone, and then I just started cranking out calls.
That's the best way to master. Get it on the phone.
Yeah,
same thing. Door knocking. That as a teenager, I would deliver papers and knock on doors, see people wanted to buy the paper.
Oh yeah.
Before that, so I guess it started there. But yeah, sales is a priceless skill, no matter if you are actually in sales or not.
Yeah, most definitely. Yeah, and I think everyone is in sales to a certain extent. I mean, if you're married, you sold, your wife that you have great values, that she should be with you, and vice versa. So no matter what, you are in some level of sales. Some just have a higher level than others.
Yeah. If you're a CPA and you're selling yourself for a raise, you have to sell that you're worth the extra money. Any W-2, climbing the corporate ladder, even if you're not in sales on the corporate ladder, you still have to climb it with some element of sales.
Yeah. Talk to us about when you started weeding out, that sales job, essentially W-2 type of role, and getting your feet wet into real estate. What's that look like?
Yeah. So I started off in sales and was doing really well. I was maxing out my Roth IRA. I became, an accredited investor by doing well in sales, and I knew I had to do something with my money besides just throw it in the 401k, stash it, which was great. It gave me a layer of diversification, but I knew I had to do something for this extra income. Still living below my means.
Oh yeah.
And I saw stocks and real estate, two big wealth builders in America, and so I saw stocks as a faster route. I looked at that. I said, okay, this is going to be a quicker way to get what I want. So started to talk to people who were day trading, started to look at different options, and I put some money in GoPro, and GoPro was at $35 at the time.
Wow.
And the CEO decided not to go into the drone industry for some reason. Didn't want to go heavy in that, and some other decisions, and the stock went from $35 to $5.
Oh shit.
So it went away, and I was watching it from 35.
You've been seeing it tick down.
It wasn't quite the, I'm still in W2, and I'm like, in the middle of sales, I'll click over and watch it.
Yeah.
Spending just as much time, as an active investment on my passive investment, losing money, losing time, with no decision at all. So, and then I put some money in a small pharmaceutical company. That small pharmaceutical company did pretty well, helped offset a little bit of that loss, but I still had the loss over here. And so, okay, stocks, we'll keep this a passive way, dollar cost average still with the Roth, and, invest slowly, but let's look at real estate as a wealth builder.
And when you started looking at real estate, a lot of people jump into single family. So what was that first initial, opening for you?
Yeah. And I was it didn't take me long to get out of single family, but single family was my first step. I bought a house, rented it out to my girlfriend, who is now a wife and mother of our child. And her friend rented out one of the rooms. And at the same time, bought a little single family. It was $90,000. I put $25,000 down. The rent was $950. The mortgage was $500. The guy was a good resident too. He paid me first of the month. There was no horror story, anything like that. But it was a couple months in. Is this is going to be, what am I going to do? Buy a house a year for 10 years and, not even be that comfortable at the end of 10 years. So I was like, this is going to be way too, it was great. I got started, did the Bigger Pockets school of training, self-educated books, conferences. But then I just looked at commercial real estate and saw these guys doing big things, a lot of equity, a lot of partnerships. And I saw that as a way to go bigger, faster. Everyone I was listening to, they're saying, what's one thing you would have done differently? At the end of everything, what's one thing you would have done differently?
Bigger, faster.
Go bigger, faster, get into commercial real estate earlier. It was always this graduation into, commercial real estate. And so I didn't want to just sit around and wait to graduate. I wanted to get into it. And I knew I had to choose one vehicle, and that was multifamily for me at the time. I understood the principles of single family and the scalability of commercial real estate, and I felt that multifamily was a good avenue. So right after that first unit, I had a 12 unit under contract while I still own that first unit, like 6 months.
So with those first and then the 12 unit in the first 6 months, let's talk about raising capital. A lot of people struggle with raising capital, and I wish someone told me right when I first got in this industry, become a capital raising machine.
Yeah.
And that's what I preach to the whole team, is we are a capital raising machine. And in adding that value to investors. So how is that capital raising for those deals? And what lessons did you learn that, you still do today?
Yeah, it evolved a lot. In the beginning, I was just trying to do deals. So that first 12 unit, I had a family friend that I had finally convinced I ran the numbers. Here's worst case scenario. Here's best case scenario. He did a promissory note. He didn't even get equity. He just wanted a, percentage. So, after that, I did a seller financing 20 unit, and then another seller financing 22 unit. And then I refinanced that 12 unit, paid them off, and bought another 12 unit. So I wasn't really raising cap in the beginning. Besides that first promissory note, I was just getting sellers equity, sellers to carry, and the bank to do the rest. And I think it was just, I didn't have the operational knowledge yet to feel comfortable enough asking other people for money.
How's those conversations with seller finance?
A lot of times it was like ugly looking apartments, so I wasn't going after the nicest apartment on the block,
Yeah.
and I was going after off market deals, and I was willing to pay closer to their price that they wanted. I almost every time I was giving them the exact price they wanted, but I needed seller financing terms. So, you know, actually seller financing is starting to come back around, but after I started doing it in, past 5 years, seller financing, sellers just like you're asking, they don't know. Seller financing, no, I want my equity. I want to go roll it into the next deal. But these sellers, they were a little more incentivized and they were okay.
Were they older seller, older that just wanted the cash flow?
All mom and pop. At the time, I thought it was C class. Looking back, it was probably D class properties. Looking back now, I mean, there was a rent. There was a rent that was a three. There was a three behind one of the rent. $395 was one of the just paying. So
Slow.
I mean, I remember walking this 20 unit and man, just feeling.
That's the square footage of a studio.
Yeah, it was. I mean, it was not the best part of town, and
but everyone needs a place to live.
Everyone needs a place to live. These guys, these mom and pop owners would just have it so cheap. They bought, 20, 30 years ago from when I got started 7 years ago. So
they're walking away still with a profit.
And these residents are afraid that they call in, they got mold in their apartments. They're afraid they're going to call in and the rent's going to increase. So they're just not saying anything. They're okay living those conditions. Yeah. But it also at the same time, it's like, man, I'm blessed to not have to live in this situation, doing due diligence on that.
We were in the multifamily industry, and then now we're in car washing. We're not ever more than likely ever getting back into the multifamily space. But when we were first getting in, we were looking at C type of assets, and when we would do unit walkthroughs, I would just tell myself, how could people live like this? Like I couldn't fathom it.
It's unbelievable, and sometimes it's families in there, and
yeah.
That's part of the silver line on the multifamily. If you're buying the C class, you are providing them a better place to live.
Yeah.
You're giving your investors a good return, but at the same time, you're not saving the whales by any means, but you're doing a service. If you're doing it right, you're not being a quote unquote slumlord.
No, most definitely. And so from there, close to 100 units you had, right, with no partners.
That's right. Yeah, I had just under 100 units, no investors, no partners, from that promissory note, from a bunch of seller financing, building those up, rolling those into the next deal, and then friends and family kind of started seeing what I was doing, just talking about it, and just started raising money from some friends and family, and went on to take another 400 units down. This was 50 units, 82 units, 40 units, 70 units, 14 units.
So you started raising some outside capital at that point when your friends and family were like, hey, I see what you're doing from afar. Can we get in? Can we learn more?
100%. Yeah. So I proved the concept. I was proving the concept for myself and for, outside capital. So, at the time before them, it was just my name on the line and my equity, but now I'm bringing in outside capital. So even at that time, I wasn't, posting about it on social media or something, which I probably should have been doing earlier. But
yeah, so I mean, obviously we post heavily on social media. Social media has changed the game. Podcasting has changed the game. Look at the presidential election, that's coming up. We're doing this podcast at the end of October right now. But I mean, look at the presidential election, which we'll see here in November. Most of those candidates are on podcast. Joe Rogan and Trump's going tomorrow, which is Friday. Harris was on Call Her Daddy. So it's a new way that the not necessarily just the American population, but everyone in the world is now consuming knowledge.
Yeah, we could go down that rabbit hole too, but that's why censorship is so important not to be, because knowledge is so widely spread. You can just turn on a 30-second video and find out something new, or you have access to private investments across the country.
And things are going to change. I mean, statistics already show alternatives and private investments are outperforming the stock market. And I think you're definitely seeing even these Wall Street brokers and Wall Street firms move into alternative investments on the private side. And you're seeing more Americans want to tap into that because I think they're getting a little tired of, just being placed in the stock market into that type of system.
100%. I'm not all in on multifamily. I have 80% 70% multifamily, but I always tell people to diversify.
Oh, you should.
I'm never like saying you need to go all in on one avenue. I think it's, especially even crypto I dollar cost average into crypto. I don't know if that's going to give me great returns at the end of the day, but it's a layer of diversification for myself at the end of the day.
No, most definitely. So started bringing on investor capital. Then you said, okay, well, with this investor capital, I got to go buy more deals. What did that look like? What areas were you guys focused on?
Yeah, so those first 100 units and 500 units was my backyard. So I started in my true backyard, 15-minute radius, and then I kind of expanded to about an hour radius. And I'm getting up to 500 units. I'm kind of starting to run out of doors in this 500 units. And at the back of my mind, I knew what syndication was and, maybe wasn't quite comfortable with it yet, but I didn't want to be a full-time operator. I liked the apartment business because you could build out that system. You could build out and get a COO or an asset manager. So I knew that I would like to be just raising capital. And from doing the operations, I knew that I would like focusing on. It was a lot more fun to talk to investors than it is property managers when they said, like, I'm finding out problems on a property, way after the fact. So.
It's hell. I'll tell you that. It is hell when you have those calls with the property managers and they want to bring something up and then you say, well, how long you known about it? Oh, a couple months ago. Why wasn't I aware? We have one property manager, not naming names, but she loves to email as she's telling us instead of asking us. And I don't like that. I nip it very quick, and I've already nipped it multiple times, but that's something that you don't do is you tell us something instead of asking. Like there was a couple times she did something without our knowledge and says, oh, this is what I did. It's like, you didn't even approve that with us. I was like, nope, go ahead and reverse it. You're not going to operate this. It's really remarkable.
Yeah, even when you do have that layer of property management, you still have to manage them just like you were managing it.
You really do at the end of the day. I mean, and that's why I think you're seeing a lot of people bring it in-house. You guys have it in-house.
That's right. We started that last year. Similar to you bringing on, we were talking before this, you bringing on a COO for your car wash business. Yeah. We brought on, because that's a behemoth in itself. Property management, it's not a super lucrative business. It's not
really cash flow heavy.
Yeah, business. For us, it was another arm of the investment arm to really bring on more transparency and more control to find out these issues as they're happening, not, a scared property manager or not as vested property manager telling you a while later. So we brought on a badass CEO, Tessa. She runs the property management side, and it's been really great to have her on our properties, that we can self-manage. We had a lot of different partnerships, when we first got started. So, some of those partnerships we may not have had majority. So right now our property management has just taken over about half of our portfolio. And then anything new we're doing, we're saying, we have to use our own property. That's one of the requirements for us to partner up with someone is we've seen third party and we've seen those situations. So that's a must.
Yeah, going forward. Definitely. More control and more transparency.
Yeah.
It's all about communication and knowing ahead of time.
Yeah. That's a huge piece of the puzzle to the multifamily, especially.
Where are you guys focused on, or I already know where you guys focus on. You guys have really ventured out into the Midwest heavily as an investment. What are you finding attractive out here in the Midwest?
Midwest is great. I think there's something I was reading on the way in. 8 of the 10 top Midwest cities besides Detroit and Chicago have experienced year-over-year rent growth.
Really?
So you're getting a lot of good job growth, a lot of good rent growth. It's still landlord-friendly area, and not a lot of institutional capital is going after it. So it's not quite as inflated.
Competitive.
Yeah, the prices aren't getting as inflated as some of these other markets where Austin, everyone saw that happen.
Yeah, Austin's now going through a tanker.
Yeah, exactly. So you're kind of catching the ride before it gets to, we still like the Southeast, still like Dallas a lot, but who doesn't like Dallas or who doesn't like Florida, So it's
no, they're still great markets, but I don't think they're going to grow. And I said this earlier on another podcast. I don't think it's going to grow at the rate that we saw in 2022. I noticed we had a property in Greenville, South Carolina, and our property manager was pushing rents $200 to $350 per unit with just paint and carpet. And I said, that's great. and let's hurry up and sell right now. But that's not sustainable. You can't sustain that for our investors. And I need to think long term. So we sold those. Our investors very happy. We exited. But that's when we pivoted because I said it's going to be very difficult to see that type of growth anytime soon.
Can't just clean it, before it was like, way before it was, you could almost just clean the apartment and you could get a little bit
Oh,
rent.
yeah, you get
Now,
$25-$50.
now you got to gut it.
Now you got to gut it, spend $7,000 to $12,000 per unit, depending on what you're putting in there, and then hope you get $100.
Yeah. Yeah. So the C class, the markets has evolved. I think we're almost, as long as it's business friendly, landlord friendly, job growth, population growth, checks those box, then we're looking at the market. Then asset class has moved away from we're still offering on C class, but it's harder to get them to make sense when what you're saying, you're having to do $12,000 renovation and you're getting $100 rent increase.
Oh, I know.
And that $12,000 renovation, you're not able to leverage that either. That's 100% of your equity you're having. So your cost of equity
is a lot higher.
So your returns aren't as big on those value add plans, and it's riskier to do the bridge debt, when we've seen what happened with some of our bridge debt properties. It just adds so much layers of risk when you can take that out in some of that B and A's.
No, I definitely think so, and I think you're going to see a lot of new product hit the market, and some of this product's wild. So a 3 exits down, I looked at an apartment complex. It's a high rise with my son and I said, let's check it out, see if we like it. It's just him and I. So I said, hey, if we like it, we'll move in together. And he looked at it and he goes, Dad, this is like a luxury hotel. And I was like, I know, bro. And they have a masseuse Thursday through Sunday on an app. So they have their own app. You can schedule a masseuse if you want. They have a masseuse room downstairs. $50 per workout if you want a private trainer. The pool is heated during the wintertime, which we don't get crazy winters, snow maybe a couple times a year. But the pool is heated in the winter, 24/7 pool. You have a sauna, a steam room, a indoor hot tub, outdoor hot tub. You have your own fishing pond in the backyard. And I'm like, why would I not want to move in?
Yeah, sign me up. So did you guys get the lease? Did you?
We didn't because my lease is not up till March. But I am emailing them because there's a specific unit I want. So I've been emailing them back and forth. But I am also having to swallow, like, do I want to pay that much?
What's it? What's that?
So it's a 3-bedroom, 2.5 bathroom, 2,100 square feet goes for around $4,600 a month. But you do have all those amenities.
Yeah, I mean, you don't need a gym. You don't need And
I work out at Lifetime. That's $350 a month. So once you start calculating it, you start to see it go down. But $4,600, you got everything right there at your fingertips. You have a barista who makes you coffee in the morning. It's like
that's
maybe you try it for a year, see.
Yeah, I think you'll get a taste, and then it'll be hard to
get the heck out. And then you have walking distance to grocery stores, restaurants, and things like that. And it's like it's perfect.
That's almost a niche in itself too. That extra layer of A class too. That's not we're usually not top of the market for A class. Having those extra that's something else to manage. Now your property manager is managing the sauna, the masseuses, the personal trainer.
I had a girlfriend, and she's this is Uptown Charlotte. We call it Uptown. I would stay at her place when I didn't have my son, and so I'd stay at her place, and they had an indoor hot tub. That thing was broken 90% of the time, and I was just thinking as an apartment owner, because we own assets, I'm like, wow, this must be a big line item. Not only that, elevators. Elevators are very expensive. People don't realize what you have to budget just for maintenance and requirements by the state for elevators. Those are expensive. Elevator goes down. That could be $1 million, depending how tall your building is.
Insurance, the extra insurance you have to get once you have elevators. The liability if that breaks on someone. I mean, it's a whole different. It's almost like assisted living is its own niche. You have this A class layer.
Oh yeah,
that's its own niche, and it's a little bit risky too if you're at the top of the market. So what happens when you're at the very top?
They're gonna have to lower their prices.
Yeah.
And then what happens? A domino effect of class A, B, and C. Because if you're in a class A or a B, and you're gonna say, well, now this brand new class A is priced out at where I'm currently paying, but it has all these type of amenities. because they need to lease up so they can increase their cash flow. I'm just going to move there.
That was always the thesis for C-class when we got started, 7 years ago, 8 years ago. C-class is more recession resistant because when the A's can't afford the A's, they go down to the B's, B's goes down to the C.
Yeah.
But I think there's so much A-class online
that they're really going down.
Yeah, and I think there's another, thesis for the A-class. If you're not at the top of the market, you can still have room to go to, there's still going to be people that want to work from home that may live in Charlotte only on a 3-year stint for Chiquita or one of these companies, maybe they're moving back out. You still have high income in that A-class area. So I think.
Oh, and that building's like 97% occupied.
Yeah.
And I'm like, they're not lowering rents anytime soon.
Yeah.
I might as well go buy some land and build my house and, have some farm animals with my son and I, because they're not lowering rents anytime.
Now we're talking.
Running at, see, that's, I'm torn between it, because Stephanie, her and her boyfriend live out in the country, and I love that. I love having land. I have a lot of friends, and I stay with them, and they have land, horses, cattle, and it's just peaceful out there.
Peaceful. You can do agriculture write-off too if you have enough like 4-legged animals. You can do some sort of tax.
Some farming, having a farmland.
Yeah. And what about it? How old is your son?
I hope you're enjoying today's episode. Just a quick reminder to make sure you never miss an episode. Stay connected with us by following us on social media platforms, Instagram, Twitter, Threads, TikTok at Chris_Salerno_. And don't forget to subscribe to YouTube to catch the video versions of our episode. You'll get exclusive content, behind-the-scenes footage, and much more. Head over to YouTube, Chris_Salerno now, and hit the subscribe button. Stay tuned because we've got more great content coming right after this. 4.5 going on 25.
Yeah, exactly. Yeah, he's asking about this A-class. That's awesome. I mean, and having that for your son to see, and that's amazing. That's what it's all about.
They grow up so fast. It's unbelievable. Unbelievable.
I have a 20-month-old now and another one.
Congratulations. Boy or girl?
It's gonna be. I have a boy now and another boy on the way.
Oh, your wife's gonna have a handful with 2 boys.
She was excited.
Oh my goodness, it's just a whole nother world. I've said this before. If I had, and I was a stepdad at one point to a woman, I like to say they grow up quickly. But she was 6 and till 9, and if I had one that was solely myself, that was a woman, I would definitely be a lot more softer. Yeah. With my son, him and I, we trippy. So he's big into soccer. And at night, I have him with the never give up type of mindset and mentality. But him and I are tripping each other, shoving each other, our faces in the grass. And I want to train him that way, because when he gets out on the field, that's what those kids are going to do.
Yeah.
They're going to, so I would rather have him train like this. So when he gets out there, he knows they're going to come for him.
I have some scratches right here on my face, and that's from William, us just getting after it. 12 months, I'm trying to pull. I think it's the moms keep them alive. The dads
toughen them up,
and teach them how to stay alive.
Yeah,
themselves.
And you need a good fine balance of both, in my opinion.
Yeah,
especially into today's world that we live in.
Yeah, 100%.
So when it comes to these Midwest type of properties, how you said you're seeing some job growth, you're seeing some increase on rents. How's your current portfolio? And congratulations, you guys said you got another deal coming up too, so that's exciting.
Yeah, got another one from the developer. So our past 4 have been straight from the developer, and our Midwest properties are performing excellent right now.
Love that.
We're at the end of 2024. It is a down, some are asking, is this the bottom for multifamily or commercial real estate? Where people are arguing if it still has more to go. So to see that performance in a down market, it pitches more into the Midwest story, for us. Like, okay, these are doing really well in these markets, and, where other properties, they're doing fine. And some are, pain in the butt. They're causing twice as much work as we expected than we wanted, but it's really making a case for the Midwest. But it is becoming harder to buy in the Midwest. Overland Park, Kansas, where we bought a 200-unit townhome, we went after another one in 2024, and it was owned by Blackstone. There was 3 other REITs going after it, and the price went up $5 million in the best and final round between the beginning of the best and final and
are you kidding me?
Yeah, there's $5 million swing, and
now I'm used to hearing that, prior to 2022, where it's like, hey, they're up 20 million. I'm like, How'd they get up that high?
This is 2024. Yeah, middle of 2024. So,
Wow.
I think there are some very institutional type. Overland Park, Kansas is one of the more institutional types. So finding these other submarkets, the deal that I talked about outside of Dallas, it's in Burleson, so it's 15 minutes south of Fort Worth. So finding, you like those
Pockets.
those pockets next to those target markets is another value, too, is finding the.
And insurance has to be a little cheaper. I mean, I know the Midwest has tornadoes and things like that, but obviously from the coast, insurance is a lot cheaper. And taxes too.
Yeah. In South Dakota, we had it was about $300 a door still on our when we bought it September 2023. Same, or one in Northwest Arkansas where I'm at. Very goes up very minimal compared to our properties in Houston. Insurance has doubled, more than doubled. So
wow. And with these Midwest properties that you guys are acquiring, are they a little longer hold, or are you guys still doing that 3 to 5 year type of hold?
I think as I get older, I would love to do more longer holds, and we talked about that too before the recording. But I think our investors are so used to 3 to 5 years. They're really like anything we're doing has to make sense in a 5-year business plan. We want to look at 3. We'll start looking to exit as soon as we own it for a year.
After that year, yeah, it makes sense to start, seeing if you can exit at a very close multiple for your investors.
Our investors would love shorter time frames, but really, it's scary to predict what's going to happen in 3 years. I think it's going to be a great market in 3 years, but that you're almost kind of taking a gamble on that, for multifamily specifically because where we're at in the market cycle. So, has to make sense for us in a 5-year hold. Would certainly like to do.
I think a lot of investors got definitely spoiled. And don't get me wrong, like it was fun buying a deal and 12, 14 months later, go ahead and sell it and double your money. Like that was fun.
Mm-hmm.
But I think what a lot of in the misconception is that they forgot that this game is Monopoly. Monopoly takes hours to play and to complete and finish. That's what we're doing in real life. It takes years, 5 to 10 years. It's not you're going to flip a 200 apartment complex in 12 months. Now, don't get me wrong. It's happened. People have made tons of profits, but I remember speaking to investors and they're like, oh, you don't have a high 20s IRR in 2 years. I'm not investing with you. I'm like, sorry, like we're not the right group for you. And then we went down to they were at high 20s, we were at low 20s. Then they were at low 20s, we were at high teens. And then they went to high teens and we were at low teens. And we were just kind of like a little ahead of the curve. But we've had a lot of investors back in the multifamily space just say, hey, we're not investing because your IRR is too low. And it's like, and now see every deal I look at is anywhere from 13, 14%.
That was also part of the problem of the social media. They're so used to seeing these advertised high returns too. So that's I can go get that. But it is kind of coming back to reality now too. If you look at these REITs, it's 10% or less, that they're advertising.
And I think you're going to see this reality for quite a while. I mean, I think you're going to. I don't think you're going to see crazy low interest rates like we saw. As low as it gotten. I mean, I remember when some of them were high 2s, which is wild. And I don't think we will, and this is anytime soon, that we will be in a position where we're going to see the $300-$400 rent bumps just with a snap of a finger.
I think Jerome Powell said, the new norm for mortgage rates is going to be 6%, or that's like, it was somewhere 5 or 6% was a new. Before for us, it was 3% was great. 3% was kind of solid. Anything above or below was great. But
yeah, I'm interested to see in the next 5 to 10 years if it creeps down to that 3 to 4% or 3.5 to 4.5%. It stays steady there. I think it will in the next decade. I think it will be 3.5 to 4.5%.
Yeah, right now I think the deal in Dallas we were quoted 5.65% if we were to rate lock today.
Wow. Well, I mean, that's still good.
But yeah,
it's market.
Interest only.
What are you seeing leverage and interest and amortization right now?
65% is a new 70 to 80%. That's the norm. That's the new. Before it was 80%. Let's go.
I mean, some people got 90%.
Yeah, 90% layer on pref. Which is
wild,
even higher. So. Yeah, 65% is a new. You're going to get your best terms at 65% for the agency lenders. See, whether that's CMBS or Fannie or Freddie, 65% now. If you want to layer in pref, you can get up to 80%.
Mm.
And pref, you have to be careful making sure you're partnering with the right pref provider.
Oh, they'll come in and sweep you.
It does, yeah. It adds a layer of extra risk. So we're trying to avoid pref. If we are going to look at pref, it's got to be some, we're fine tuning every, document there where it's not
Oh, yeah.
hard pref versus soft pref. So there's different layers to the intricacies of the capital stack. And you learn that from being out there in the weeds. It's like, yeah, I'll add this layer of pref, and it juices my returns, 5%. But at the same point, something goes wrong, they can come in and swoop
Easily.
take it out.
Yeah. Have you seen, running, because you mainly run the capital, at Elevate, have you seen the negotiation for some of the deals that you guys are negotiating? Because I remember people would say, 30-day DD, 15-day close. We've done that with some deals back in the day, or even 15-day DD, another 15-day close. Like, you got 30 days to come up with that capital. Are you seeing you guys are kind of extending, or are you seeing in the space it's a little longer now instead of a 60-day close, it may be a 90-day close, just given because of the debt environment and raising capital?
100%. Yeah. 120 days. I mean, the deal we have under contract was 120 days, but that was in negotiation with the developer to allow it to get to 90% so we could get that fixed rate debt. But anybody who's saying 60 days, unless they're coming in all cash or,
Or they have a fund that has already cash
that's already raised, then it's going to be, they may say 60 days, but I guarantee at 60 days, they're buying another 30 days. So we're saying it on the front end. Hey, we would like 90 days. We'll buy our 2 extra 30-day extensions, but that's realistically what it's going to take. The due diligence for us, if we can run that pretty smoothly because we have the construction arm, so that can go quicker, but really it's on the financing side of it, making sure your debt is solid and your equity.
They're taking their time. I mean, all of our deals are recourse deals. So, huge risk there for us. And with the type of assets, it's a lot. I remember when we got our first car wash loan and we showed them our multifamily portfolio, they laughed at us. They said, I don't care if you've managed multifamily before. And we're like, what are you talking about? Like, collectively, between our business partner, we're close to $2 billion worth of multifamily in our portfolio. And they're like, we don't care. I'm like, what? You guys don't care? They're like, no, we don't care. And I was like, wow, okay, this is new to us. It's a whole different world on the lending market, especially different asset.
Did you have to bring on someone with
No, well, our COO has experience, but they didn't care either, because this was all of our first deals collectively back in the day, and so they didn't care about that. What the number one thing they cared about, which everyone in the multifamily space lacked, is what's your current cash flow?
Yeah.
What's that current cash flow that you have? And we know everyone in the multifamily space is hurting for cash.
Yeah.
And so we had to show high current cash flow. And they wanted to see, okay, what are you bringing in on a high, on a monthly basis in your pocket net take home? Because they want to see, well, if they have to foreclose on this is recourse, can they go ahead and swoop in and take that cash that you have?
Yeah. And that's more aligned with the car wash business model too.
And that's why I think I was just in a panel about alternatives, and a guy who was on the panel asked me, a lot of people are getting into the space, and I'm like, from social media, it may be a perspective that they're getting in. However, I can promise you they're probably not getting in, because these recourse loans are scary, and you have to show you have high income for these recourse loans, or they're just not lending to you.
Yeah. You have to really feel good about the deal to do recourse loan.
Oh, and you have to really convince this lender. Like, it's not like multifamily where the lenders just give out a loan to anybody. It's very, very difficult in the multifamily space.
Yeah, that creates a layer of kind of protection though too, so you're not just anybody can come in,
Correct.
Weeds out the competition a little bit.
Correct. Yeah. Like, you have to have credentials. You have to understand and know how to operate these car washes before you can just think you can come in and get a bank loan.
Yeah. It's not all just pictures on social media. Now it's posting behind the car wash.
Nope. Even though I do that, but I do know how to operate one. I do know how to get into the nitty and gritty of them.
Yeah.
But I spent all of 2023 doing it. while everyone was freaking out about deals and not doing deals, I was touring manufacturing facilities, chemical plants, you name it.
Oh, wow.
Oh, yeah.
Sitting down.
Owners, operators. I was signing NDAs to see your personal bank statements because I didn't believe the numbers at first. Like, I was getting down and dirty. I traveled nonstop in 2023 to get an understanding of it because I told myself, well, if I'm going to sign personally liable, if I'm going to bring investor capital here to buy these deals, I need to understand this like the back of my hand. Because this is not just like a multifamily deal where you go in, you change the granite countertops or to quartz, or your laminate to quartz, and then put new cabinets or paint the cabinets and then call it a day. Like, this is a whole different ballgame.
I like that. It gives you an extra outside layer of perspective too. You got this multifamily experience and you're looking at it with a different eye than just someone who's already been doing car washes. You have a different
A whole new
outlook.
experience. We are revolutionizing the car wash space. I will say this because if I don't think our competitors listen to my podcast, but if they do, good. I love to compete, so bring it on. But we are transitioning where all the car washes in our markets are kiosk, where everyone goes and just touches the kiosk. We are taking away kiosks and we're doing tablets, just like Chick-fil-A does. It's a better interaction amongst our sales associates and our potential members, so they can upsell. And the number is actually 62%. A conversion rate that they upsell to become a member based from a single wash because someone has a tablet and they're having a more interaction.
Yeah, it makes sense. It's like you're putting the human component back in, but you also have the opportunity for upside there too. I think is huge.
Yeah.
And so for the upside, you're probably detailing it or just
No. This is an express, so it's monthly, but they get different type of packages and things like that. But with the tablet, you can flow the line quicker. That's what Chick-fil-A does. Chick-fil-A flows that line quicker, and you still some Chick-fil-A's you still have to pull up to one single window to get your food. Others are now doing 2 windows, where now you have pipes that shoot your food out. It's crazy. But we are trying to stay on the cutting edge of everything, especially with AI, sensors, all of that's coming out.
Yeah.
Totally different ball game from multifamily.
Yeah, I love it. I do a touchless car because they did a ceramic on my car, so I have to do the touchless.
Yeah. And which is great too. I know some guys who care about their car. If you're putting ceramic on your car, you care about your car. You do the touchless. Some people I know hand wash their car.
Yeah.
But 95% of the population, I mean, I drive a white Range Rover. I bring it through our washes.
Nice.
Yep, I bring it through our washes. I mean, if it can't wash my car, why am I going to have it wash another customer's car? That's the way I think.
So vouch of approval right there.
Yeah. So excited about that space. Where do you see multifamily? I know you said is some a little promising in 2026, 2027 with the turnaround. Where do you see it?
Yeah, I think at the end of 2023, people were saying survive to 25 was like the saying.
Now it's like 27.
Live to 26, see to 27. What does 27 rhyme with? So
I know, right?
I think we'll be personally, I think we'll be in a really good position in 2024 into 2027 it's going to be humming again. What happens when interest rates go back down? People are willing to pay more. We're already seeing that a little bit right now. Blackstone is saying they think it's already bottomed. They made a $10 billion investment into multifamily. So they're a lot smarter than me. They have a lot more money than me, but they have different agendas too. So that you could say at one point that signals a bottom because they're willing to put that much on it. But
you're right. There's different agendas for them.
So we're seeing, we're a lot more closer on deals right now. We submitted 300 LOIs this year, and we have one deal from the 300.
That's what you got to do.
Yeah, so it's not just because we're sitting on, hey, I'm gonna sit on the sidelines and see what happens. You have to be active to see what happens.
Are you guys going to be and stay aggressive in the Midwest? You think it will go back to Southeast or mainly Midwest?
Midwest, Class A, straight from the developer. If we can buy straight from the developer and we can buy in the Midwest, we'll be more, quote unquote aggressive compared to, what we would be on a C class in Houston. We're still going to make an offer on that, but it's probably way below what they owe on the property. Might not work, but the A class we can get to pencil a lot more. So I think I would almost say we're market agnostic right now. Just we've made offers in Cincinnati. I've never owned in Cincinnati, Lexington, but I like that kind of tri-state area. I like the North Carolinas a lot. We have a property in Columbia, South Carolina that's killing it right now too.
Be careful with Charlotte. Charlotte's crazy. A lot of inventory is coming on in Charlotte.
Yeah, and you have to know someone that's there.
Yeah, call me up if you ever need anything.
Yeah, Winston-Salem, all those little submarkets.
Yeah.
For sure, yeah, we will. I like those kind of Winston-Salem areas over there. Probably not the Charlotte.
Greensboro and Winston-Salem is definitely growing. Greensboro, Winston-Salem, there's that other High Point. That whole area is definitely growing. Charlotte, to me, there's a lot of office space that's been just going gangbusters with office rent, but still we're running at, I think, like only 60 or 55% occupied in office space out of the whole city of Charlotte. But the multifamilies, there's so much development coming on. There's so much product coming on. And like I said, there's crazy amenities with some of these properties. And a lot of them are offering 2-3 months free rent.
Yeah.
A lot of concessions.
Yeah, we're seeing that from a lot of developers. Adding more concessions. They went in with these high pro forma rents because their business plan starts 2 years before, or even 3 years before.
And you don't have a crystal ball to say what's going on.
And these developers were very spoiled, just like everybody else was spoiled. Developers were very spoiled.
Oh my God, yeah, they were getting dirt cheap interest rates on their construction loans.
Dirt cheap interest rates, still buying land very easily. They would have people take over at completion of construction. They wouldn't have to worry about lease up. They would assume the lease up risk.
Oh, I remember that. People would just buy it with, and they'd go and lease up themselves.
So that's almost become, a niche for us, or a business, a target focus for us. Like someone saying, I'm only investing in Kansas City. We've been more vocal about developers. We would like to work with more developers taking it off to their hands where they're getting out for their basis. We're getting a brand new developed product for the same cost to build, without the development risk. And then you have a nice, less maintenance, less CapEx risk with a finished product. And then the A-class model is really proving itself because you have all these people since COVID, a lot more people are working from home, and you have a lot of people that are, like I mentioned earlier, not living in the same place. They may live somewhere 1 to 3 years versus they want to go buy a home, or maybe they test out a market before they buy that first time home.
Yeah. No, wealth of knowledge, Brian. I appreciate you coming on. I'm excited to see what you guys do here in the Midwest with years to come. I follow you on social media and things like that, so I love everything you post and all the educational stuff about your deals that you have coming up. So keep crushing it out here in the Midwest, and let's see where things go with it.
Yeah, you too, Chris.
Thanks so much. Yeah, likewise.